What's up, traders? Charles here, aka Mr. Best. Welcome to Ever Best Trading Hub. And if you're new to this channel, please do well to subscribe and turn on the notification bell so that when I drop videos, you will be one of the first people to have access to it. All right. So that being said, today's video will be looking at 3 chart patterns to focus on. These patterns are pretty popular to a lot of traders, and for those that are beginners traders, those that are just starting out in trading forex or binary trading, it can be overwhelming when you look at the different chart patterns that we have in the market and don't really know the one to stick to, because you can't just trade all of them. Trading all means you end up losing money, because you need to be consistent with just few things. You need to master few things, right? Just like the last video that I said that you need to trade few pairs. Same with the chart patterns, you need to trade few chart patterns, right? So from the numerous chart patterns that we have in the market, I decided to talk on just 3 of them. And as you can see on the chart, the first one is bullish and bearish flag. Then the second one is on triangles, and we'll be looking at M and W. M and W happens to be one of the most popular chart pattern we have on the chart. If you just open your charts, M and W just everywhere, but then I will give us a clue. So sit back, don't skip this video, don't just watch half and go away. Watch to the end, because I'll be giving us a clue on how to trade this M and W the smart way, right? I'll be showing us how I trade M and W and how you can also trade M and W. So that being said, let's forge ahead. I'll be going to talk about the different chart pattern before we look at them in real life on the chart. So the first one we have here, this is number 1. We'll be looking at the bullish flag and bearish flag. So this formation, let me start with the bullish flag. This formation is as a result of the market giving an impulsive move. So this from here, this is an impulsive move to this place. Some traders call it the pole of the flag. They call it the pole, but I like to call it the impulsive move of this flag. So once you have a very nice impulsive move to the upside, immediately followed by a consolidation phase, you see the market start being choppy or start ranging in a very tight range to the downside. You can see that this range is tilted towards the downside, right? After a very nice impulsive move, and you start to see a very tight range market moving towards the downside, then you start to observe that bullish flag formation is in play, right? You don't just conclude until you see the formation. I will tell you where you will now know that, okay, it's time to take a trade. So once you get a very nice impulsive move, a very tight range consolidation phase to the down, it must tilt to the downside. It must not be horizontal, right? It must tilt to the downside. Then you observe and see when the market, so at this point you can bring your trend line and put your lower trend line and your upper trend line to identify that tight range, right? So what you're going to do as a trader is to anticipate when a candlestick will break above the upper trend line that you've done. When it will break and close, not just break then you rush to jump into the trade. No, when it will break and close, to be sure that the market is out of this tight range phase, right? So once you see a candlestick close above this upper trend line, it's time for you to take your trade. So some traders like to see break and retest of that trend line before they will take a trade, while some other traders, just once they get a very clean break and close, they'll just jump into the trade. For me, I like to jump in once I see a very clean break and close above this line. Then if I get a retest of that line, let's say the break up and close above or was not very close to this trend line, if it's kind of like this range, I will enter my first position. Then if I see a pullback to that upper trend line, then I see reversal candlestick after the pullback, then I will enter my second entry. So pretty much this is how I trade my bullish flag. Then of course, if you want to your stop loss should be below your entry, and some pips below your entry, and your take profit should be the length of your impulsive move. So for some persons like to take the range from the start to this to the one inside, but I like to take mine from this start to this one before the tight range. I like to take from the start to the end before this tight range, and also I will offset there from my entry forward, and that will be my take profit. Pretty much the same thing with your bearish flag. If you're trading the bearish flag, you want to see a bearish impulsive move to the downside, and followed by what? A tight range consolidation, and it must tilt to the upside. Remember, for the bullish it will tilt to the downside, and for the bearish it must tilt to the upside. So what you're going to do is you place your lower and upper trend line to identify the tight range. Then you're anticipating when price will close and when it will break and close above the lower trend line of your range for you to take a trade. Stop loss above, stop loss and take profit below. Then the range should be the impulsive move from the start of the impulsive move to the point where it starts to enter the tight range. That is where you want to offset as your take profit target. So this is how the bearish flag works, and pretty much a very nice chart pattern. I've been using it. Is pretty consistent if you take the trade when you're supposed to, when all the confirmation, everything is in place. So that being said, let's look at the second chart pattern that we'll be talking about, which happens to be the triangle. So after we've talked about all of them, we'll now go to the charts and see them in action. So before I continue, if you're new to this channel, once more, please subscribe to this channel, drop your comment, share, likes, or just interact with the channel so YouTube can send this video to more persons, right? So the more subscribers I get, the more content I'll keep dropping free of charge, right? So now back to the triangle. The triangle, we will be looking at 3 of them, right? There are a lot of other chart patterns, but I kind of settle with these 3, and I feel is beginners will really enjoy trading just this 3 and be consistent with their trading using these 3 chart patterns. So the triangle is a chart pattern that also have an impulse move followed by a consolidation phase, but the consolidation is not like the flags that it will give you a specified range. No, for this triangle, the consolidation is kind of, it starts big, and as it progresses to the right hand side, is shrinking in size. So for example, we'll be starting with this ascending triangle. Ascending triangle is that you want to see an impulsive move to the upside. Then after the impulsive move, the market will retrace to the downside, pull back to the upside, retrace to the downside, to just be making these swinging moves, right? And as it progresses to the right hand side, it will be shrinking. Observe that from this point to this point is bigger than this to this. It's also bigger than this to this. So one unique factor about the ascending triangle is that the upper side of the trend line will be at 90 degrees, right? It will be horizontal. So you see that this, my upper trend line, is horizontal. It is not slanted like the lower trend line. The lower trend line is tilted or slanted to the upside. It's a perpendicular line, while the upper trend line is an horizontal line. So this is the distinguishing factor between an ascending triangle and other types of triangle. So once you see an horizontal or trend line to the upside, and the lower trend line is slanted to the up, then you anticipate what? A break above this horizontal line. Then also, once you get a break above, you can either wait for a candlestick that will break above and close for you to take a trade, or you wait for a candlestick that will break and close above and you wait for retracement for you to take a trade. Remember, I talked about candlestick reversal pattern that works, right? So when it's retracing, you look out for those candlestick reversal before you take your trade. But if you want to take your trade immediately, it closes and it breaks and closes above, go ahead and do so. Make sure you put your stop loss below. Very important. I don't trade without stop loss and take profit. Don't allow anyone tell you otherwise. Always trade with your stop loss and always trade with your take profit. So the target level can be, you can just do what works for you. You can either take from this start of the impulse move to this point that is entering into this triangle and offset it up, or you can take from this point to this point and offset it up. Basically, whatever works for you. For me, I kind of I talked about the risk to reward ratio that works in my previous video. If you've not seen it, you can go back and check it. After this video, you can go back and check it. Now, I like to target 1:3 minimum. So if my entry is here, I just target 1:3 and I'm good for the day. So this is pretty much how ascending triangle works. And let's look at the second triangle on the triangle list here. We are having descending triangle, which is the direct opposite of the ascending triangle. In this case, you want to see a bearish impulse move to the downside. Then you see the market start having these swings up and down. Then you want to see the lower trend line should be horizontal 90 degree, right? And the upper one should be slanted towards the downside. For the ascending, it should be slanted towards the upside, while for the descending, it should be slanted towards the downside, and you want to anticipate what a candlestick that will break and close below this horizontal line, below this 90-degree line. Once you have that, then you take your trade, put stop loss above, take profit below. Then you, the same thing here, you target this impulsive move, or you go for with ratio like me. I can go for 1:3 and I'm good to go. So the third one on the list is what we call symmetrical triangle. A symmetrical triangle in the sense that you can't, like this ascending triangle, once you see it forming like this, you should anticipate what break above. For the descending, you should anticipate what break below, right? That is your bias. But for symmetrical triangle, you don't have a particular bias. The breakout can either be to the upside or to the downside, right? Because the two slanted trend lines are opposite to each other, right? They are opposite to each other and they are symmetrical in nature. So it can either break up or break down. Once you have a break above to the upside and closes, you can enter, or you wait for a pullback before you enter. Same with the downside. If it breaks below, you enter, or you wait for a pullback to continue the movement downward. So this is how triangles works, both for ascending, descending, and symmetrical triangles. So the third one and the last on our list is what we call M and W, which happens to be the most popular chart patterns at the moment, right? So this M and W is a chart pattern that looks like M and also looks like W. So yeah, I'm sorry, I mistakenly this went out. Let me just correct this. Okay. So M and W is it occurs in different category or different variant also, just like our triangle. For the M and W, there are some cases that you see that these two legs of the M and W will not be equal in nature. Like this is just the equal M and W legs. You can see that this point and this point is the same. This point and this point is the same. In some cases, you can see that the right hand leg of this M will be higher than the left, and in some cases you can also spot that the left side of the M will be higher than what the right hand side. Whichever case you have spotted them, just know that M and W was great. And for you to trade M and W the right way, for me, what I like to look out for in an M and W, okay, before I tell you how I like to look at M and W, how I like to trade M and W, let me tell you how generally people like to trade M and W. So people want to see that when this M and W this is an impulse move, a kind of a buy move, a retracement to the upside, then it continue with another impulse move to the downside. So this intersection between this left side and this right side is what we call neckline, right? So this neckline, traders like to see the market breaking below this neckline. So once a candlestick breaks below this neckline and closes, traders want to jump in and take their trade. That's why I put the sell arrow here, right? But for me, I like to trade the other way around. I like to get into this trade at this second leg, at this point. But what I don't just see the formation like this, and jump in here. No, what I like to see is I like to see any of my reversal candlestick that I'm using. Or my previous video, I mentioned engulfing bars and morning stars and evening stars, right? So if I see engulfing bars, whether bearish, this okay for here, this is M. When M chart patterns occur, you look for sell opportunities. When W chart patterns occur, you look for what buy opportunities. So when I say M chart pattern occurs, I like to see a bearish engulfing bar, or I like to see an evening star here at this tip of the second leg. Then I can now take my right to the downside, then put my stop loss very tight, because I'm very much aware that it can decide to go up instead of coming down, right? So taking a trade there is risky, but it has the most reward, because if I enter there and someone is waiting for the market to break here to start entering, at this point to this point, I'm already in deep profit. I can even decide to close my trade from here to here and I'm out, because in some cases I've seen where the market moves from here to here, it did not break below the neckline to continue down. It just make a U-turn, right? So this is how I trade my M and W. The same thing with the W. I like to look for a bullish engulfing bar here or a morning star here for me to take my trade. So one thing about the M and W is that it's a reversal candlestick, right? When you see an M form, it means the market was previously a bullish market. Then the M and W can send it to a bearish market downward, right? When you see a W chart pattern, it means the market was previously a bearish market. Then the W will send it toward a bullish market. So M and W are reversal pattern. For your triangle is your ascending triangle and your descending triangle, they are continuation pattern, right? Because you can see the market was what? Buying and continuation, right? Then your bearish and bullish flag, they are also continuation pattern. So here we have two continuation pattern and one reversal pattern, but there's a way you can trade your M and W and it will look like you can trade it as a continuation pattern also. But for this video, I just explain it as a reversal pattern. Of subsequent video in the future, I will explain how you can use M and W as a continuation pattern. All right, so enough being said, let's look at how we can spot these chart patterns in our live market and how we can use it to trade. So yeah, starting with this is M pattern. This is how the M pattern looks like. You can see it has a previous impulsive move here, pull back, pull up again, and you can see it falling. So this is where I like to take my trade to continue downward. Then the second one here is what we call, okay, let's look at the W. This is W. You can see the bearish impulsive move to the downside, pull back, and what continuation. So in this point, at this point, you can see that this is my second leg of my W. This is what a Morningstar setup. So this is where I'm going to take my trade if I'm currently trading this chart. And if you've watched my previous video of how I created my risk to reward ratio, then I just follow my risk to reward ratio tool. And yeah, this will be my entry, stop loss below this week. And like I said, I target 1:3. So this will be my take profit target. You can see from here to here, I'm out of the market. Sweet move. So I like to see this kind of trade. So the second one we're looking at is the symmetrical triangle. You can see that they are symmetrical in nature, and we anticipate what? A breakout to the up or to the downside. But in this case, we saw a breakout to the upside. You can see this bullish candle that closes above this trend line. Clean breakout. So if you want to trade immediately after the breakout, then you take your risk to reward ratio tool. Your entry will be at the close of that bullish candlestick, then stop loss below this week's. And for me, I'll just target my TP3. You can see my TP3 also resonate with my levels here, my structure. So this is serving like either a supply zone or a resistance line. So it will make more sense for me to take my profit here. Or if I see that there's momentum in the market, for example, there's a very big momentum candle here, so I can hold it to my TP5. It even surpassed that and keeps going, right? So don't allow greed to set in. Just go with your risk to reward target, and you're out of the market. So if you want to wait for pullback, also you can see that at the candlestick breaks and close above, there was a pullback to that trend line. So you can jump in here. Also, this is 1 hour time frame. You can go to the lower time frame like your 15 minutes or your 5 minutes to look for a reversal candlestick on this line for you to take a trade. So let's look at the next one, which happens to be our bullish flag. Yeah, so this is a bullish formation. Like I say, you have what? An impulsive move to the upside, then followed by what? A tight range consolidation market. And it should be this flag called the consolidation market should be tilted to the downside. You can see slightly tilted to the downside. So what you're anticipating is what? Price to break and close above this upper trend line, like in this example here. So this is where you will be entering your trade. And in this example, you can see that there was no pullback to the downside. Like I said, I like once I say close break and close above, I will enter my first trade. Then if I get a pullback to this place, I will enter my second trade. So reason being that if I don't get a pullback, I will already have a trade running for me, right? So I don't miss out. For people that are waiting for pullback, they would have missed out on this move. In this example here, my two trades will give me a very clean rewards, right? Because the first one I entered will get to my TP, and the pullback also will get to my TP. But in this example, it's only one position I will use because I entered this one and there was no pullback. So let's see if I'm using my risk to reward ratio. Let's see what we can have here. My entry there, my below this candle is my risk, my stop loss, and you can see that this is a clean 1:2 ratio. It didn't get to my 3. So at this point, maybe I will end up closing at 1:1 because I've moved my stop loss to secure 1:1 ratio, right? So that being said, let's look at the next one, which happens to be our ascending triangle. So this is how I like to draw my ascending triangle. The side that is horizontal, that is 90 degrees, I like to represent it with a rectangle, right? Just like this. and you can see my lower trend line that is tilted upward. So you see this is the impulsive move to the upside, and followed by this swing, this consolidation moves to the upside, and this is the break and close above this candlestick here. This massive bullish candlestick is what breaks and close above. So I like to trade, I will take my first position just immediately the candlestick closes, and my take profit will be below this wick. This will be massive for me. I'm not going to use this, so I would like to use something like this. Then once the market retraces back almost to my take profit one, and it pull back to my trend line or my 90-degree level, then I can enter the second position here. So I have my two positions running. You can see 1:3, a sweet one, even up to 1:5. So this is one of the these are the kind of moves I like to see in the market. So let's look at the last one, which happens to be our bearish flag. So this bearish flag, you can see the same thing that we saw in our bullish flag. There's a bullish impulsive move to the downside, followed by what? A consolidation phase that is tilted to the upside. Then you want to get you want to see a break and close below the lower trend line. So this is where the break happens. Then for me, I will take my first position immediately the candlestick that broke below closes. My stop loss will be above somewhere here. Then like in this case also, we have after the break there was a retest to this level. Then you can for those that like to see retest, you can jump in there. For me, two positions running, and it's a clean 1:3 ratio, even 1:5 if I choose to wait. So this is how you trade your these three chart patterns that I just explained. So if you're a beginner trader, just know that having this focusing and mastering these three chart patterns will really save you a lot of time, a lot of money wasted, and build the right psychology within you. Then if you feel that this three pattern, there is some of them that you don't like, let's say you don't like triangles, or you don't like M and W, you don't like bullish and bearish flag, then you can substitute them with any one of your choice. But make sure you don't target or you don't focus on more than three chart patterns. Three chart patterns is enough. I know people trading just one chart pattern. I also know people trading just two. And I feel for a beginner, 3 is cool, right? So after trading 3 chart patterns for some time, you will come to the conclusion of either focusing on one of them, 2 of them, or continue trading with the 3 of them. So this is it for the video. If you're new to the channel, you've not yet subscribed, please, this is a short reminder, subscribe so that YouTube can get this video to as many people as possible. Thank you so much. This is where we'll call it a day. See you on the next one. Bye for now.